I think you're right to say that the net interest margin moderated slightly in the second quarter. A lot of them were mainly because of the rising cost of funds. But like I was guiding that in our June exit NIM itself, we are already back to the 2.14%. So what does that mean when the Fed actually did another round of interest rate hike? Probably that gives us a little bit more upside on the way forward. We think that the loans will be repriced and we'll be able to manage our cost of funding a lot stronger, mainly because of the flight to quality for the Singapore depositors. I'd just like to add that the incremental cost of our funding for FDs are already lower than what it was last year. So we are hopeful that the NIM will stay for the following quarter with some upside biasness following this morning's announcement by the Fed.
Wai Fai, Will here. I just want to ask you one question. I promise it won't be about Taylor Swift. But in terms of what you're seeing on the loan growth front, because I look through all of the data and I continue to see, a deceleration in Singapore, a deceleration in Hong Kong, deceleration across all of ASEAN. It's basically similar to what we are seeing around the rest of the world as well. So are you confident that you can retain the net interest income that you're getting, even on the NIMS front moving forward, to take from part of what JP was saying, considering that credit contraction is happening and it's happening at a pretty rapid clip despite the growth in ASEAN?
I think you're right to point out that the macro environment aren't that flattering. There are a lot of worries about where the US are, about China itself. And China growth isn't as impressive as we hoped it to be. And their current problems within their own domestic economy and property sectors and all are slowing some of the export down. That being said, we think that Southeast Asia will remain resilient. So there are a few things that are actually moving in our favor, right? One is the changing trend of the supply chain. We see a lot of customers moving out of China and coming into the region itself. We saw that really accelerated in the last 1-2 quarters. So we are hopeful that despite a challenging first half, second half will a lot be better. And with some of the opening up of the economy, some of the trade-related activities will pick up. So we guided that we will be at least a mid-single-digit loans growth after a flattish or a 1% growth in the quarter, which means that we are expecting to see activities coming back, especially now that people got used to the high interest rate environment, that you'll hear higher for longer. So some of those we see customers are coming back into the market.
Mr. Lee, just zeroing in again on those net interest income figures. Now, we saw for the first half of this year, it actually posted significant growth. But when you look at sequentially compared to the second half, especially in some of the key Southeast Asian markets, we actually saw net interest income actually decline for the likes of Singapore and Malaysia and even that of Greater China. The one thing that was interesting, though, is that a lot of the growth seems to have come from Thailand, which, again, when you look at it, comparatively speaking, their growth rates in terms of GDP lagging that of some of their neighbors. What are you seeing with regards to loan growth in Thailand and why it showed up so strongly in your net interest income figures, at least for the first half?
Thailand benefited significantly from our Citi acquisition. So for the Thailand Citi acquisition, a lot of those were in the unsecured space. So that gives me higher margins. And I think that's why you see a very huge increase in Thailand compared to the rest of the world. Malaysia itself, although the Citi acquisition has been completed, their unsecured portfolio is not as big. So Thailand actually is one country that benefited significantly from the Citi acquisition.